Hello and welcome to Lecture 3. My name is Nathan McNamee. We'll be discussing the structure of interest rates. This comes from Chapter 3 of your book. In the previous lecture, we discussed Chapter 2, which looked at how interest rates are determined and what are the factors that feed into what makes up an interest rate. Today, we're going to talk about structure of interest rates. So let's get started. The objective of our chapter is to describe how characteristics of debt securities, such as bonds, cause their yields to vary. We'll demonstrate how to estimate the appropriate yield for any particular debt security, and we'll explain the theories behind the term structure of interest rates, which is a relationship between the term to maturity and the yield of securities. So how far out the maturity of the debt security is will affect the yield on that security. So why do debt security yields vary? The yields on debt securities are affected by a number of factors, um, and the main ones that we'll discuss in this lecture are credit or default risk. So whether or not the company that has sold the debt security will be able to pay back the investor. Is there a risk that they will default, that they won't pay it back? Liquidity risk, which we'll get into, tax status, and term to maturity. So how long until it matures? So let's first look at credit or default risk. Investors must consider the credit worthiness of the security issuer. All else being equal, securities with a higher degree of default risk must offer higher yields. And that makes perfect sense. If you're invested in a company that you think there's a good chance that may default, or sorry, if you're looking at potentially investing in a company and there's a reasonable chance that they could possibly default at some point in the future, you would expect a much higher yield. This is especially relevant for longer term securities. If it's a short-term security, then the default risk is significantly less. You'll understand whether or not they're going to be able to pay you in the short term. But longer term securities, the default risk becomes a lot larger. So in general, securities with a higher degree of default risk offer higher yields. So how can we measure whether or not a company has a potential for default? Well, one source of information we can look at are rating agencies. Rating agencies charge the issuers of debt securities a fee for assessing their default risk. And so we can look at that. And if you look in your book, there's a table or exhibit 3.1, which we'll take a look at here in just a second. And so these rating agencies, and the two most popular are Moody's or Standards and Poor, they will rate the debt, and that will determine whether or not people will demand a higher yield, because the rating agency helps to identify and assess any default risk. Accuracy of credit ratings. The ratings issued by agencies are useful indicators of default risk, but they're just opinions and they're not guarantees. The oversight of credit rating agencies was changed in 2010 with the Financial Reform Act of 2010. It was established, it established an Office of Credit Ratings within the Securities and Exchange Commission, the SEC. So now they have an Office of Credit Ratings in order to regulate credit rating agencies. Rating agencies must establish internal controls. So you can see where if the rating agency is being paid by the issuer of the debt, so the company that is borrowing the money is paying the rating agency to assess their default risk. And so there's an inherent conflict of interest. The rating agency is being paid by the company who they're rating. And so they may have had incentive to have the ratings higher than than expected or than they should have been. And so this new oversight will hopefully establish internal controls at the rating agencies, which will help reduce um, potential errors in ratings. So here are the ratings assigned by Moody's and by Standard & Poor's. Here's a description. So you've got the highest quality, or AAA in both cases. Interestingly enough, a lot of people look at the US government as the most credit-worthy institution and a very safe place to purchase bonds from, but the US government is not AAA rated. At the time of this recording, it is AA+. So there are actually 2 companies in the US that are AAA rated. Microsoft and Johnson & Johnson. So 2 companies have better ratings than the US. So you can see we've got highest quality, high quality, high to medium, medium quality. We get into the Bs at medium quality, triple B, double Bs, medium low. Low quality is B. From this point onward, we call these junk bonds. They're poor quality. There's a lot of risk associated with them. And the lowest quality has a high chance of default. So these rating agencies are published, and you can see what any publicly traded company has as far as the major companies that have debt out there. They're going to be rated by one of these agencies or both. The next thing we are going to talk about is liquidity. The lower a security's liquidity, the higher the yield preferred by an investor. So you'll remember liquidity has to do with how easy it is to sell it, how easy it is to turn it into cash, or at least a reasonable valuation of your security. So if it's not liquid, you'd have to sell it at a steep discount in order to get the cash. Debt securities with a short-term maturity or an active secondary market have greater liquidity. You remember, secondary market is when people who already own the security, let's say it's a bond, already own the bond, can sell it to another investor who wants the bond. And so if there's an active secondary market going on, it really increases the ability to sell it and have liquidity there. Tax status is another key factor. Investors are more concerned with after-tax income. So it really depends on how they're invested and what entity is investing. There are tax-deferred accounts where the trades do not create tax consequences, such as a 401k or an IRA. Taxable securities in a taxable account, like a normal brokerage account, must offer a higher before tax yield because investors will end up having to pay tax. So this is a great table to show you. In this blue area, we have the before tax yield of different securities. So there's a security yielding 2% before tax, 4%, 6%, and 8%. But what does that look like after tax? So the investor has to pay tax. If your tax rate is 10%, you can see your 2% before tax yield is now a 1.8% after tax yield, all the way up to this 8%, where the after tax yield would be 7.2. And you can see the higher the tax rate, the more effect it has. So if you have a tax rate of 35%, your 2% yield would actually be a 1.3% yield. And going up to our 8% before tax yield becomes a 5.2% after tax yield. So for taxable bonds, they have to offer a higher before tax yield to entice investors to invest in those bonds. So how do we compute the after-tax yield? Well, this first up here, this first formula shows us how to calculate the after-tax yield. So here's the yield. AT stands for after tax. So the after-tax yield is equal to the yield before tax times 1 minus the tax rate. So as I mentioned, this represents the after-tax yield. This represents the before-tax yield, and T represents the investor's marginal tax rate. So in order to, if you know what the after-tax yield is and want to calculate the before-tax yield, we just algebraically move this around. We've got the yield before tax is equal to the yield after tax divided by 1 minus the tax rate. So it's a very simple formula to determine what the after-tax yield is. And the fourth and final is the term to maturity. This is a factor that affects the structure as part of the structure of interest rates. So maturity dates will differ between debt securities. The term structure of interest rates defines the relationship between term to maturity and the annualized yield. So here we've got the term to maturity. So this is 1 month. And then we'll get into years, 2 years, all the way up to 30 years. So let's assume these are bonds. These are the yield of treasury securities. So these are treasury bonds. So we've got our T-bills down here, and up here are our treasury bonds. And you can see the longer the maturity, the higher the annualized yield. So investors will require generally a higher yield if there's a longer maturity. And that makes sense. You wouldn't want to invest for 30 years for a low amount. But if it's short-term money, you would expect, well, I know I'm not going to earn that much because it's a short amount of time. And we'll talk a little bit more about this here later on in the presentation. So let's now talk about the actual yield differentials. So the small yield differentials can be relevant. And so what I'm talking about is the difference between two different securities and their yields. And that difference, although small, can be relevant. The yield differential is the difference between the yield offered on a security and the yield offered on the risk-free rate. So this yield difference can be significant. And they're sometimes measured in what we call basis points. So this would be 1 basis point, 1 BP would be the way it'd be written. What that represents is 0.01%. So 100 basis points would be 1%. 1 basis point is 0.01%. And working in the investment industry, we used basis points a lot to discuss yield, to discuss our fees, how we were paid. We were typically paid, and we discussed basis points. So maybe it was 0.75 basis points we were paid. Yield differentials on money market securities is the next topic. Yields on commercial paper and negotiable CDs are only slightly higher than T-bill rates to compensate for lower liquidity and higher default risk. So T-bills are very liquid. Commercial paper and negotiable CDs, CD stands for certificate of deposits. We typically will get those at banks. Commercial paper is short-term debt, typically with corporations. And so these yields are typically slightly higher than the T-bill rate. So this is the treasury bill or the short-term treasury bonds. Treasury bill rates are slightly lower than these other two to compensate for their lower liquidity. Commercial paper and CDs are less liquid and have a higher default risk than T-bills. But when we're looking at money markets, you'll remember that the securities in money markets are less than a year. And so we're talking very short term. So we're talking, the differentials will be very small in low basis points. Market forces cause the yields on all securities to move in the same direction. What about yield differentials on capital market securities? So on the previous slide, we looked at money markets, capital markets, now our longer term bonds and stocks. Municipal bonds have the lowest before tax yield. That's because municipal bonds are tax-free. Um, so we don't pay federal tax on our municipal bonds. So municipal bonds have the lowest before tax yield, but their after tax yields are typically higher than those of treasury bonds. So treasury bonds, again, has a lower default risk than municipal bonds. For instance, I'll give you an example of a municipal bond. Let's say you live in a town and the city wants to build a new golf course. It's going to be a city golf course. The city may not have all the cash sitting around to do that. One way that they could finance that is by issuing bonds. So individual investors or institutional investors could come in and buy some bonds that are being issued by this municipality, the city. And what if we have a major pandemic and nobody can go out and play golf? Well, most of golf course type bonds are what we call revenue bonds. And so all the revenue from the golf course is meant to pay off the bond. Well, what if the revenues stop? What if there's some major issue? Or what if it's mismanaged? Municipal bonds have a higher likelihood of defaulting, and we see that historically. There are a lot of famous municipal bond defaults compared to treasury bonds. So while their before tax yield is lower, when we take into account the fact that we have to pay tax on other types of bonds, the after tax yield of municipal bonds are typically higher than those of treasury bonds. Treasury bonds have the lowest yield because of their low default risk and high liquidity. They're very actively traded compared to other bonds. I had a client who had invested in some municipal bonds and wanted to sell them. And it took them about 4 weeks before they could find a buyer for those municipal bonds. And it can take longer than that. Treasury bonds, though, are very highly traded, and so they're much more liquid. This shows yield differentials of corporate bonds. And so you can see we've got the green line and the blue line, and they move in the same direction as the previous slide mentioned. But you can see the green line is the AAA company, and the blue line is the BBB or BAA if we're looking at Moody's. So you can see that the lower credit, or the ones with the higher credit risk, investors require a higher yield. This is the yield percentage. And so the companies with the lowest risk, so the Microsoft and the Johnson & Johnson, they'll be able to borrow at this rate, whereas a company at the BBB range will be able to borrow at this percent. So we can see that there's a differential depending on credit worthiness. So how do we estimate the appropriate yield for a debt security? And here's the formula. So the yield of an in-day debt security, so this is time. This could be a 1 year, it could be longer or shorter, is equal to the yield of an in-day treasury security. So this is our risk-free rate for the same period. Plus our default premium to compensate for credit risk, plus our liquidity premium to compensate for less liquidity, and then our adjustment due to difference in tax status. So these are the different things that make up our yield. So we start with the risk-free rate, and then we add premiums because of different types of risks that are associated with debt securities. So those are the way we would estimate a yield. So now let's take a closer look at the term structure. We're going to discuss a couple of different theories. The first one is called the pure expectations theory. So this theory states that term structure reflected in the shape of the yield curve is determined solely by the expectation of interest rates. So, and we'll talk about yield curve and what that means. But this theory talks about it's solely dependent upon the investor's expectations of interest rates. So where are interest rates going to be in the future? And investors are often wrong with this, but these are, this is the way pure expectation theory works. It's based on expectation. So what is the impact of an expected increase in rates? It leads to an upward sloping yield curve. And we'll look at that. It's in your book as well in figure or exhibit 3.5. We'll look at a chart here in just a second. What about an expected decline in rates? That leads to a downward sloping yield curve. Okay, so this slide looks busy, but really there's two sections. We've got a normal looking yield curve, which is sloping up. And then this is an inverted yield curve, which is sloping down. So let's discuss these. So here we've got, again, remember, we're talking about expectations. So what is expected? So the yield curve is the current yields on a range of maturity for debt securities. So we can see 3 months to 10 months. So the yield curve is sloping up. Normally you would expect that because of the longer time, there's more risk on the securities. So investors require a higher yield as opposed to the shorter time, they require a lower yield. So here we've got the market for 3 month. This is the short-term risk-free debt. So that's the 3 month. And you can see demand at time 1 and demand at time 2 with the supply at time 1 and supply at time 2. So we can see in this case that the interest rate drops, the equilibrium rate drops here as a result of changes in the quantity of funds demanded and supplied. Looking at the market for the 10-year risk-free debt, you can see at the same time that equilibrium, which we started with I1, we expect it to go up. So supply goes up and the demand goes up right there. And so this is the normal yield curve, as we look down here, we can see this yield curve, the short-term maturity has a higher yield than the longer-term maturity. And there are several times in history where we see this. This is what we call an inverted yield curve. This is a normal yield curve. So this is what we'd expect during normal times. So these yields in the future are dependent upon expectation only. So if we expect things to go more poorly in the future, we can see that will affect the future yield curves. So algebraically, we can look at the pure expectations theory, where we've got this first term, TI2, is the known annualized interest rate for a 2-year security at time t. Okay, so this is our 2-year security, and we know what the annualized interest rate is for it. Then we've got a known annualized interest rate for a 1-year security right here. And then we have a 1-year interest rate that is anticipated as of time t plus 1. So we can look at it in 2 ways. We can buy 2 1-year securities, one which matures in 1 year, then we use the proceeds and invest it in another. So what is our anticipated rate as of that time? And that will affect or be equal to the known annualized interest rate according to of the 2-year security. So again, we're comparing buying 2 1-year securities to buying 1 2-year security. And according to this theory, those should be equal to each other. There's another theory we call the liquidity premium theory. Investors prefer short-term liquidity securities, but will be willing to invest in longer-term securities if compensated with a premium for lower liquidity. So the estimation of forward rates, so that's the future rates based on the liquidity premium. You can see we've got an additional term here. LP2 is the liquidity premium on the 2-year security. So this is another way of looking at it, where we have we've got the 1-year security and the 2-year security, but then we add the liquidity premium onto that to get the value or the rate for a 2-year security there. Again, this is the first year security, this is the 2nd-year security, plus the liquidity premium equals a 2-year security. This slide, we're going to discuss the impact of liquidity premium on the yield curve under 3 different scenarios. So our first scenario, the market expects stable interest rates. The second scenario, the market expects an increase in interest rates. And the third scenario, the market expects a reduction in interest rates. So what we have here, the blue line, let's look at this first, where we're just looking at stable rates. We don't expect rates to go up. The interest rate without the liquidity premium included would just be a flat line. But because of the longer term to maturity, we are requiring a premium. You can see that premium gets higher and higher as that's included in the total interest rate. And you can see between the blue line and the red line, the longer term maturity, the higher the demanded liquidity premium. So what if we expect an increase in interest rates? Then the blue line shows, again, the liquidity premium being removed. So the rates are going up because of expectation in the future, that we expect an increase. But when we include the additional premium, you can see the difference here between the red and blue line. The liquidity premium, the longer the maturity of the security, the bigger the liquidity premium included. And then a similar story here, but just going down. This is without the liquidity premium, and this includes the liquidity premium. So let's take a closer look at the term structure. We've got another theory that's called the segmented markets theory. This theory suggests that investors choose securities with maturities that satisfy their forecasted cash needs. So those with cash needs in the future, distant in the future, they'll choose longer term securities. Those with more immediate cash needs will invest in shorter term, so maybe money markets. So there are some limitations of this theory. Some borrowers and savers have the flexibility to choose among various maturities. So an implication of this is what we call the preferred habitat theory. Although investors and borrowers may normally concentrate on a particular maturity market, certain events may cause them to wander from their natural or preferred market. And we see that and are seeing that right now with the events relating to COVID-19. People who might normally be drawn to a longer term maturity tend to shorten up their maturity when there's risk or uncertainty on the horizon. So there's been a lot of research on the term structure theories that have been proposed, and researchers have looked at those. Interest rate expectations have a strong influence on the term structure of interest rates. That's the one thing, one of the things that research has found, that expectations do have a strong influence. However, the forward rate derived from a yield curve does not accurately predict future interest rates. So while we can see what the longer term interest rates are predicting, um, they're usually not accurate. So if we can look at the yield curve and see what is the current yield to maturity for a 10-year security, usually if we go 10 years into the future, it was not accurately predicted. This suggests that other factors may be relevant when looking at term structure and how they affect interest rates. So some general research implications: although the results differ, there's evidence that expectations, liquidity premium, and segmented markets theory all have some validity. And to a certain extent, all of them have been shown to be valid. So if we assume the following conditions: investors and borrowers currently expect interest rates to rise. If we assume most borrowers need long-term funds while most investors have only short-term funds to invest, and investors prefer more liquidity to less, then all three conditions place upward pressure on longer-term yields. So the long-term yields will typically be higher relative to short-term yields, leading to upward sloping yield curve. As I mentioned before, an upward sloping yield curve is a normal yield curve as opposed to an inverted yield curve. So here we go. We've got our different theories represented by the different lines. So this first one is our expectations theory. You can see it suggests a normal upward sloping yield curve based on expectations. This is our expectations theory plus the segmented markets theory. You can see again the effect: the long-term maturities have a higher yield as opposed to the short-term maturities. And then when we add in the liquidity theory, again, we can see that it gives us a normal yield curve. So these are the factors that we need to consider as we're looking at future interest rates. So as we look at the use of the term structure, forecasting interest rates can be a challenge, but the shape of the yield curve can be used to assess some general expectations of investors and borrowers about future interest rates. Again, they don't always predict the future, but it tells you how investors and borrowers are feeling about the future. What are their expectations about the future? And the curve's shape should provide a reasonable indication, especially once the liquidity premium effect is accounted for, of the market's expectation about future interest rates. So we're looking at expectations of investors and borrowers. So when we see a inverted yield curve, some analysts believe that a flat or inverted yield curve indicates a recession in the near future. And that can be the case, but it's not always the case. So when we see inverted yield curves, a lot of people start using the word recession, that a recession is on the horizon. And there have been times where we've had inverted yield curves and we did not go into recession. However, to my knowledge, and based on what I've read, there hasn't been a time where we've had a recession that wasn't first preceded by an inverted yield curve. So while an inverted yield curve doesn't always mean a recession is always preceded by this inverted yield curve. And last year, 2019, we saw the yield curve invert several times. And so people were looking forward to, and the expectations of investors and borrowers was potentially negative for the future. That was before COVID-19 came on the scene. And so I think it's all but certain that we have a recession coming. So the inverted yield curve does have some meaning, but it doesn't always guarantee that we're going to be going into a recession. So we can use the term structure also in making investment decisions. If the yield curve is upward sloping, so the shorter term are lower interest rates or yields, and the longer term are higher yields, some investors may attempt to benefit from the higher yields on longer term securities, even though they have funds to invest for only a short period of time. So they'll invest in long term securities to try and get the higher yields, but they only have short term funds. Also, when we're looking at financing, firms can estimate the rates to be paid on bonds with different maturities, and this may enable them to determine the maturity of the bonds they issue. And so as they're looking to maybe issue bonds or sell bonds, these debt securities, in order to raise funds, they can look at the term structure to determine where they want to come in at based on the current yields of the different terms. So why does the slope of the yield curve change? Conditions may cause short-term yields to change in a manner that differs from the change in long-term yields. And we'll look at Exhibit 3.8 here in just a second. So how does the yield curve change over time? And we'll look at 3.9 as well. Yield curves at various dates are illustrated there. Okay, so here we go, the potential impact of treasury shifts from long-term to short-term financing. So here's our demand 1 and demand 2. So our short-term interest rate was set at 3%, and we see a shift in demand. And so we can see here that the interest rate is going up. The long term in this example, we see a shift. The quantity of funds or loanable funds demanded is less, and so we'll see a drop in the long-term interest rates from 7% to this IL2. This is our long-term. So IS2 is short-term, IL2 is long-term. So the green is where we were, our yield curve, our original yield curve. But as we see these changes, here's the short-term change. We move up, and the interest rate goes up from 3% to whatever the new rate is. And the yield curve, the long-term interest rates is expected to come down. So what we see here is a flattening of the yield curve. Short-term rates going up, long-term rates coming down, it flattens the yield curve. Okay, this slide shows us yield curves at various points in time. So each curve represents the yield curve on a specific date. So on October 22nd, 1996, we can see we have a normal upward sloping yield curve. Our shorter term maturities were in the 5 to 6% range, and our longer term maturities were between the 6 and 7% range. So you can see that sloping up. These others are sloping up, but you can see October 22nd, 2015, it's fairly flat on the shorter term maturities, and then it jumps up for the longer term maturities. Here, the red line shows an inverted yield curve. This is in 2007, so this is just as we were about to hit the credit crisis. You can see the shorter term maturities were yielding more than the long term maturities. So this is an inverted yield curve, and at this point, it actually predicted correctly the recession. So what about the international structure of interest rates? The factors that affect the shape of the yield curve can vary among countries, and the yield curve shape at any given time also varies among countries. So you can have one yield curve in the US with a very different yield curve within the European Union, for instance. Interest rate movements across countries tend to be positively correlated. However, as a result of internationally integrated financial markets. So the actual interest rates may vary significantly across countries at any given point in time, but their movements tend to be similar. So if yields are dropping in the US, they're most likely dropping in the UK as well. This implies that the difference in interest rates is attributable primarily to general supply and demand conditions, as we looked at in lecture 2 with the loanable funds theory. So these differences are attributed to supply and demand conditions across countries, and less so to differences in default risk premiums, liquidity premiums, or other characteristics of the individual securities. With that, we've covered 4 key things on the structure of interest rates. We talked about credit risk or default risk. We talked about liquidity, tax status, and term to maturity. And all of those affect interest rates and are part of the consideration as we look at the structure of interest rates. If you have any questions, feel free to contact me. My regular office hours, you can reach me via phone or email, or if those times don't work for you, feel free to contact me and we can schedule a time that will work. Thank you very much.